Hi, everyone. Seeing that it's noon, we'll go ahead and get started as people hop on so that we don't hold anybody up on their lunch hour. Hello to everyone and welcome to today's webinar, Partnerships, Know the Issues and Facts Before Going into Business with Someone. I'm Dr. Jolene Carey Pace, the Program Coordinator at the Wilkes University Small Business Development Center, and I'm so happy that all of you could join us this afternoon. Our webinar today is presented in partnership with the law firm of Rosen, Jenkins, and Greenwald, and today we have Paul Rushton, who is a partner with the law firm and chairs its business and finance department, joining us today. Just a quick note before we begin to please put yourselves on mute so that we can avoid having any background noise. Also, as we go along, you can type any questions that you might have into the chat box, and there will also be some time at the end of the presentation to ask any questions you might have. And now I'll hand it over to Paul. Thank you.
Thank you very much. I appreciate everyone joining us today. I'm looking forward to talking to you about these issues. As Dr. Pace mentioned, I'm the head of our business and finance department. So one of the big things that we do as part of our practice is we counsel entrepreneurs and prospective entrepreneurs about both the choice of entity, as far as which entity they use to to operate their business under. And then also in those instances in which they're going to be entering into business with more than one person, more than just themselves, we help them understand what they should put in their governance agreements to help them protect themselves against a bunch of different issues. And so, as you'll notice on the slide, I said choice of entity and governance agreement considerations for closely held businesses. The thing I usually like to do at the beginning of these presentations is explain what closely held businesses are. So what a closely held business means is basically a business that's owned by by two or more individuals, and that are intended to be kept amongst those owners or people that those owners agree that can become a part of the business. So it's not like a publicly owned business where anyone could go on the market and buy. It's a privately held business, and there's provisions put in place that are intended to make sure that it stays that way. They want it to be held closely held. Sometimes the basis by which the closely held is, a lot of times they're family-owned businesses that are closely held, and steps are taken to make sure only family members own it. Sometimes it's certain professions that an engineering firm might be formed, and everyone wants to keep it held only by engineers because that's their business. And sometimes, depending on the form of entity they've formed, they have to keep it that way, which we can talk about a little bit. But long short, closely held businesses are intended to be owned by a small group of private individuals and not a larger body. So that's who we mostly represent, and that's what this presentation is really geared towards. So the issues that we're going to cover in this presentation are, we're going to touch on the available forms of business entity in Pennsylvania. We're going to point out basically in each case, who are the owners of them, who are the managers of them, and then really what statute they're bound by and what governance agreement would be put in place with respect to that type of entity. We're going to walk through for you sort of what the choice of entity considerations are when you're trying to select which amongst those business entities you would pick. We're going to help you basically break the tie in going through them based on different criteria. And then finally, and the biggest bulk of our discussion is really going to be the issues to be considered for inclusion in governance agreements for closely held businesses. And the reason for that is, this is really about going into an agreement with more than one person, going into business with someone other than yourself, and the considerations that you should take to try to protect yourself. So we're going to be focused most on that, but we want to talk about those other two issues first, because it sets the stage for our discussion about the partnership issues. So number one, let's talk about touch on the types of business entities. You have a limited liability company. We'll refer to it a lot in this presentation as an LLC. You have a C corporation or a C corp, an S corporation, or what's oftentimes referred to as an S corp, a limited partnership or an LP, a general partnership or a GP, a limited liability partnership, which is an LLP, or a sole proprietorship. There's different statutes that are in place with respect to each of these different types of entities. The LLC is governed by a more recent law, Pennsylvania Uniform Limited Liability Company Act of 2016. C Corps and S Corps are both covered by what's called the Pennsylvania Business Corporation Law. An LP is covered by the Pennsylvania Uniform Limited Partnership Act of 2016. A general partnership is covered by what's called the Pennsylvania Uniform Partnership Act of 2016. And an LLP is either an LP or a GP that's elected to be treated like a limited liability partnership. And the registration that addresses that is under Chapter 82 of the Pennsylvania Consolidated Statute. A quick note on these various statutes. I'm a member of the Title 15 Committee of the Pennsylvania Bar Association, and as part of our committee, we helped prepare the text for all the different more recently adopted one, 2016. And what we tried to do as part of that effort was make them so that they're all internally consistent and they all are really set up in the same manner as each other, subject to the differences between the entities. So if you look at these laws as you go through as part of your business, you'll find that they all are sort of organized the same way. And except for the differences that are intentional, tried to sort of be set up in the same manner in how they're treated, except for the differences. So in doing so, we've really tried to modernize the law. And I think as you find, as you go through and operate your business and looking at them, they are a lot clearer than they used to be. So let's talk about the LLC. LLC is probably at this point the most popular one. There's a lot of reasons for that. It's very flexible and everything else, but the LLC is formed by filing a certificate of organization with the Pennsylvania Department of State. Its owners are called members, and its managers, it's managed either by those members, or you can provide for one or more of those members or other third parties to manage it. And if you have someone other than the members doing it as a whole, they're called managers. The governance agreement for an LLC is an operating agreement. A C Corp is filed by filing articles of incorporation with the Pennsylvania Department of State. Its owners are called shareholders. Its day-to-day operations are managed by officers. Its governance is dictated by its board of directors. And for a governance agreement for a C Corp, it's really a combination of things. All the same things that are in an operating agreement, the same types of issues that are addressed in both the bylaws for the corporation as well as a shareholders agreement. So when we talk about a governance agreement for a corporation, we generally refer to it as the combination of its bylaws and its shareholders agreement, because together they really address all the sort of same issues that are addressed in an operating agreement. An S Corp has the same, owned by shareholders, managed day-to-day by officers, governed by a board, have bylaws and shareholders. The only difference between a C Corp and an S Corp is that you've got to file an S Corp election with the Internal Revenue Service. You used to have to do it on the state level as well. Now it's all done at the IRS. And that allows it to have different tax treatment, which we'll talk about in a second. An LP or a limited partnership is formed by filing certificate of limited partnership with the Pennsylvania Department of State. It's owned by one or more, has to have one or more general partners and at least one or more limited partners. We'll talk about what that means in a minute. It's managed by the general partners. They're required to be the ones that manage it. And their governance agreement is called a partnership agreement or a limited partnership agreement. A general partnership actually doesn't have a filing. It's formed by the agreement or by the conduct of two or more persons who conduct business together. We'll talk about similarly with the sole proprietorship, but basically if you go into business with someone and you don't file anything, but it's clear that you intended to be in business with that other person, you will have by your conduct formed the general partnership. So the only filing that's ever required with a general partnership, assuming that you don't want to become a limited liability partnership, the only filing at the Department of State level is if you want to operate your business under what's called a fictitious name. So fictitious name is generally a name other than your own names. And it's filed with the state just to make clear that if someone sees XYZ XYZ Painting, for instance, out there, people can go to the Pennsylvania Department of State website. They can see that fictitious name and they can see who's the one who are operating business under that name. GP, you can't have it if you're only one person. That's a sole proprietorship. So it has to be owned by at least 2 general partners. Those general partners are tasked with managing the entity, and then it's governed by a partnership agreement, and it can be written or oral. An LLP is really, it's a limited partnership or a general partnership that registers as a limited liability partnership. So it's the same entity, that same way you would have formed either of those other ones, but the additional step is taken to take this registration. And the reason that you do that is to get the liability protection features under Chapter 82 of the Pennsylvania Consolidated Statutes. That full liability shield, which we'll talk about momentarily, is what can now be obtained through an LLP. Previously, it wasn't a full liability shield. It was something less than that. But now it's the same liability protection that you would get, with an LLC or anything else. Sole proprietor is a lot like a general partnership, only it's one person. So if you're operating business by yourself and you haven't formed an entity, you are by default a sole proprietor. There's no filing required at the state, again, unless you want to have a fictitious name. And it's owned and managed by the person conducting business on his or her own. There's no governance agreements in place because you're the only one involved. So in choosing an entity, you say, okay, well, what am I looking for? And as a closely held business owner, small business owner, it'll almost invariably be 2 main things. The one is limited liability. What that means is owner liability is limited to their investment in the entity, and there's no personal liability. Now, there can be personal liability if you, in connection with your business, personally did something negligent, but just what this is dealing with is if just the owner, just as by virtue of you being the owner, you won't have any liability just by being the owner if you're in an entity that has limited liability. And the other one is what's called pass-through tax treatment. So pass-through tax treatment means there's no entity level tax. Everything passes through the entity and goes down to the personal income tax for the owners. So in other words, it's called a pass-through entity. That's generally more favorable because when there's 2 levels of tax, it generally ends up being a higher level of tax. So most small business owners end up being a pass-through tax entity. And so all of the entity forms we talked about earlier provide the desired liability protection, except for the sole proprietorship, which has no liability protection at all. The general partnership, which has no liability protection unless you register as an LLP, or the LP, which provides no liability protection for general partners unless they register as an LLP. Or if you form a separate entity, limited liability entity that serves as the general partner of the LP. But in general, in a limited partnership, general partners are required to have personal liability. Limited partners are afforded that limited liability, but the general partners are forced to be subject to liability. And so for that reason, sole proprietors, proprietorships, GPs, and LPs are generally disfavored as forms of entity for small businesses. There used to be a reason when there was a capital stock tax around where sometimes you would be an LP versus these other ones, but the capital stock tax in Pennsylvania has gone away. So now you very rarely see people who, are trying to be proactive about liability ever having a sole proprietor, a GP, or an LP. Rather, small business owners are usually going to go for an LLC, a C Corp, an S Corp, or an LLP. And then we call those full liability shield entities, and we'll use that vernacular just to make it easier as we go through. On the pass-through tax treatment, so again, going back, all of the full liability shield entities that we just talked about have pass-through tax treatment except for the C Corp. For that reason, people generally don't have a C Corp because they want to avoid that double taxation. And accordingly, then we're left with an LLC, an S Corp, or an LLP. And in deciding amongst those, which have both of the features we talked about earlier, there's generally things that end up being a tiebreaker depending on your circumstances. And those factors really, the main things are avoidance of ongoing administrative costs, reduction of self-employment tax, or allowing greater flexibility for equity investment. And we'll talk about all 3 of those. Number one thing that sometimes ends up being a tiebreaker, especially for people who are starting brand new, is they oftentimes opt for an LLC, and they do that to avoid ongoing administrative costs. This is particularly true where you're operating by yourself. If you're operating by yourself and would other be a sole proprietor, but you form an LLC, that LLC will be what's called a disregarded federal tax entity, which means there's no entity level informational return required. So you don't have to prepare a tax return on the federal level for your LLC. Everything just flows down to your individual returns. The other thing is, because, at least in Pennsylvania, because the Pennsylvania capital stock tax is now gone, you don't have to do an informational return at the state level either. So you avoid any additional administrative costs that you would have with having to have a tax an accountant, or by yourself, all the effort you'd have to take to file these informational returns on the entity level, and everything just rolls through to your individual return. Another potential tiebreaker, depending on what you have, if the closely held business owner expects to incur significant self-employment taxes. Self-employment taxes include things like FICA, Medicare, all the stuff that normally comes out of your paycheck when you're getting a paycheck, especially when you're employed through somewhere else. When you're self-employed, those apply as well. And in fact, you pay the employer side of it and also the employee side of it. So for small business owners who are making some good money, self-employment taxes end up being an actually really large part of what you're paying. And so what some folks do to avoid that, or to limit it rather, is they form an S corp. They then are required to pay themselves at least a reasonable salary as the owner of a S corp, if they're also actively involved in the business. And that on that reasonable salary, they then pay all the self-employment taxes. However, everything else that they take other than that reasonable salary, any other profit from the business, ends up coming to them not as something that's subject to self-employment taxes, but rather as a return of equity or distributions from the S corp. And those distributions are not taxed from a self-employment tax perspective. So this technique of having a reasonable salary paid to the owner, which can be done through an S corp, and then not having to pay self-employment on everything, is used a lot if you think that's going to be a problem for you. Now, this isn't able to be used with an LLC or an LLP because, as a partner, a member in those entity or a partner in that cannot employ themselves due to the partnership tax law, and accordingly they cannot pay themselves a reasonable salary, and accordingly the whole profit from the business that comes to them, which comes to them through a distribution generally, is subject to self-employment tax. That's oftentimes something that ends up being the tiebreaker for people. Now, self-employment tax caps out. And so if you are high enough, or if your reasonable salary would cover all of that, sometimes that's not the right device, but that's one thing that oftentimes leads people to form S corps. Another tiebreaker is, as you go through and you come up with your business plan for your business, you may know that you're going to need equity investment, equity financing. You're going to need investors who are going to come in, be interested in your business, and help fund that business through their investment in your entity. If you know that's where you're going, the S corp is a really poor form of entity for you, because equity investors typically are going to look for a preferred class of ownership. And they oftentimes seek to invest through entities that they've formed for the purpose of the equity investment. So in other words, the individual investor doesn't want to invest in his individual name, but they would rather invest through an entity they have. An LLC, unlike an S corp, permits multiple classes of ownership and non-individual owners. And for that reason, if you're planning to have equity investment, frequently people will pick an LLC because it's superior from that perspective. An S corp is required to have only one class of stock, and it can't have non-individual owners. Those are the S corp rules. So if you're planning to go down the road and become someone that attracts equity investment, usually you would not go the form of an S corp. So that gives you some of the tiebreakers that come up in trying to pick your choice of entity. And what we always recommend to people, though, is as you're making that decision, talk to your tax advisor, talk to your legal advisor. They can help you go through that analysis, and they can help you decide on these tiebreakers. Sometimes there's something else, like if you have a lot of healthcare costs that you're expecting, sometimes a C corp makes sense for that. There's other reasons that can potentially lead you to go a different way, but in most instances, a smaller, closely held business owner is probably going to either form an S corp, an LLC, or on certain cases an LLP for the reasons we mentioned. Okay. So with that said, we'll move on to what we wanted to do, the bulk of what we were doing here, which is really talking about these governance agreements. And again, to give you a sense, let's just refresh our memory from what we were doing here. If we're talking about an LLC, this governance agreement is going to be in the form of an operating agreement. If you're an S corp or a C corp, it's going to be both the shareholders agreement plus the bylaws. And if you're a GP, an LP, or an LLP, it's going to be a partnership agreement. Okay. But as we go through the rest of this presentation, I'm really going to be talking about them generically as governance agreements, because the issues we're talking about generally apply across all those different forms of things. It's just depending on which form of entity you have, it has a different name or a different format. Okay, so one of the big things that's dealt with in these governance agreements is management provisions. And when you're going into business with someone else, you want to be very clear on how the entity is going to be managed. And so, as you're deciding what's going to happen with your business, and you're in business with more than one person, you've got to decide, okay, how's this thing going to be managed? And as you're deciding on how it's going to be managed, you're deciding, okay, are we going to have some people who are quote unquote passive owners and they own an interest in the business, but they're not active in it. They're not working in it every day. Or is everyone who's an owner of this thing going to be a manager of this as well? And so that's got to be a threshold decision that's addressed up front. And then what your agreement will normally set forth is how those managers are going to, how you're going to elect those managers if it's anything other than all the owners, and how you're going to elect officers for the entities if in the case of an LLC you elect to have them, or if with a corporation you're required to have them. You'll also want to have clear provisions for when those managers or officers can be removed. In other words, when the passive owners or other owners find that, listen, you're not doing a good job for us in connection with this, and we don't want you to be in that position anymore. You want to have clear rules for what will be necessary to remove someone from those provisions. And then again, with the election, how you'll replace that person. The other thing is, if you do have some owners that are actively involved and maybe even actively are going to be the managers, and other passive owners, normally in agreement, you'd have a discussion and say, well, are there certain things that are such big issues that we don't want the managers to decide on their own, but rather we want to go down to the passive owners so that they approve these things? Big examples are admission of new owners, certain extraordinary transactions like the sale of the business. And then, what we've listed here is those can be, you can provide for them to be all of the owners of the business need to agree to it, a super majority of them need to agree to it, or a majority of the voting interests need to agree to it. So all of that, how the whole thing's going to be managed, what approvals are needed for really big things, all that all goes into your agreement. And the more that you make it as clear as you can possibly be about what's expected, the less dispute you have amongst the owners as to, oh, we should have done it this way or whatever else. Getting the rules in place and really knowing what they're going to be and making sure they match your circumstances and your goals, that's a big part of what the management should look like. Another thing that gets dealt with a lot in these agreements are what we call financial provisions, okay? And so when you invest in a business originally, what you put into that business is called a capital contribution, one way or the other, whether you're paying for your stock or whether you're making a contribution towards the entity. And what these agreements typically set forth is what's expected from everyone. What are they required to put into the business originally? What money or property or whatever else is going to be contributed for the benefit of the business. The next question is, after we all agree, okay, we're all going to put in X, Okay, our initial contribution is X. The next question for business owners is, what if we run out of money? Okay, and what if we need future capital? Sometimes what owners say is, if in that instance nobody's required to put any more money in. We talked about earlier that you have a limited liability. Your liability, if you have that in your entity, will be limited to whatever you invested in the entity. But depending on if you're required to put more money in or not, that'll be basically a determination as to whether you've got to put more, lack of a better term, skin in the game. Do you have to put more money in after the money you'd already put in? And you can provide that can be optional or required. In either instance, if there's a capital call, which capital call is where management says they need money. The other thing you got to decide is, okay, if we make a capital call and it's optional, but someone puts in more money, well, what does that mean then? Does that additional money mean that their ownership percentage should change in the entity? Or if not, then it's just a matter of, okay, well, will that be treated as a loan, or will that be treated as an excess capital contribution? And what does that all mean? So having decisions with your co-partners as to what's expected on this issue, if we need money, which we might as part of business owners, what are we all expecting from each other if we need more money? Are we all saying we'll put in the more money if we all agree we need it? That's an issue that should be addressed. These agreements also normally say that when you've put money into these things, except as specifically provided in the agreement, you can't just say, give me my money back. There's not a return of capital contributions unless it comes through as provided in that agreement. You normally want to make that clear. The other big issue on these things, and the other way that something becomes a larger potential liability for you than what you've initially invested in the thing, is whether or not, if a majority or whatever is required to borrow money, right? So whatever you say, whoever's required as part of your business to decide that the entity should borrow money. The question is, if they decide to borrow that money and the bank will require personal guarantees from all the owners, which in a closely held business, it will invariably most times do. The question is, are those owners required to personally guarantee as between the owners? Or could an owner say, well, I'm not going to personally guarantee it, and then they wouldn't be allowed to you wouldn't be allowed to get the loan. The bank would ultimately say they're not going to do it. The question is up front, if, let's say there's a 5% owner, he disagrees that the company should borrow money, but he's outvoted on it. The question is, should that 5% owner, if the bank requires it, should he be required to do it? That should be spelled out in your agreement. So that's very clear. And if you're an owner coming to be an owner and you want a limited involvement in this thing, you're willing to be a passive owner. A lot of times what we try to negotiate for those is they won't be required to put any more money in as far as capital, and they won't be required to personally guarantee. So they can keep their stake limited to what they put in, and they're not required to do anything else. Another big financial provision that comes up for owners in a closely held business is, will distributions from the entity, when and how will they be made? So the question is, who will make that determination? Number one. And, depending on the entity, the managers are generally the one who makes that determination. But secondly, is there any required capital distributions? Are they going to make distributions to you at any time that you can count on? And the reason that this becomes particularly important is in the context of tax distribution. So as we mentioned earlier, in an entity that has pass-through tax treatment, you are going to be taxed on the money that comes into the entity as the owners of the entity. It passes through the entity, remember, and goes down to the individual tax returns. It's going to be taxed to you regardless of whether you're actually paid money from the entity. So the way it works is, somebody does business with your entity, it pays that entity a certain amount of money, and by the end of the year, it's clear that income was created by this enterprise, by this entity. That tax obligation doesn't stop with the entity. It goes down to the individual owners, and you have your proportionate share of that tax liability based on you being an owner. However, the cash that came into the business, if it's not distributed out, you owe that tax regardless of whether you got any money. You owe that tax on the money that came in, regardless of whether that money is then distributed to you from the entity. And so that becomes a really big issue because you might not have the cash to pay the tax that you have to have. So what sometimes happens is owners, even if they don't want to require a distribution annually or some other period of time, like we'll distribute all available cash, they at least say on each year, as long as we have the money, you're going to distribute to me, this entity, enough money for me to at least be able to pay my taxes. Because even if I didn't get the cash, I at least need to be in a position where I know I can pay the taxes. Even if I haven't gotten other cash and I'm not making a lot of money on my business, I'm not additionally out of pocket to pay my taxes when I haven't even gotten any cash. That's one of the tax provisions that we normally deal with in there, and whether that tax distribution is in fact required and how frequently it's required. A lot of times in a business, you have to pay estimated quarterlies when you're a closely held business owner. Those estimated quarterlies come up and you basically on what you expect to make for the rest of the year, you can either do, there's a couple safe harbors. One is 90% of your current or 110% of what you paid the year before. But those come up every quarter. And the question is, okay, is this entity going to give me money on a quarterly basis so I'm not out of pocket, even if I might get paid at the end of the year for the full amount of my taxes? I could have a cash crunch in the interim because you haven't paid me. Those are the types of things that you want to deal with a partnership. And one of the things that comes up that people get worried about is if you go into business with someone, let's say, who has different circumstances than you, and they have a lot of cash and you have almost no cash. Well, what sometimes happens is if they want you out of the business, even if they don't have the right to push you out of the business, they block distributions long enough so that it's called being squeezed out by the fact that you can't keep paying these tax payments because you don't have enough money. You ultimately agree to get bought out of the entity because it's putting you in a position where you're not paying your tax obligations. Dealing with that up front and having a firm and clear understanding of exactly how that's going to get taken care of, it's very important for a business owner going into a business, especially if they don't have a lot of their own money that they can just use for these purposes. Some of the other tax provisions that are dealt with in these documents are, how will profits and loss be allocated? When the business, if it has profit or if it develops a loss, will that go according to the ownership percentage or will that be shared differently? In an S Corp, profit and loss allocation has to match your ownership percentage. That's an S Corp rule. But in any of the partnerships, you can do it differently. If you follow what's called 704B of the partnership code, you can provide for allocations of profits and losses to be something other than what the ownership percentages are. Why would you do that? Sometimes it's done for estate planning purposes, where we talked about earlier, a closely held business ends up being family members. And the higher generation, let's say the grandparents of it have more than enough money for themselves, but they still own an interest in this. And they would rather have some of that money go to children or their grandchildren who are also owners of the business. Well, they agree to a different allocation of profit so that then those children and grandchildren are getting more money out of the enterprise and they're able to then get that into their name and not have it stay in the estate of the grandparents and ultimately subject to the unified tax credit or inheritance tax. So sometimes it's used as an estate planning benefit. The other thing is sometimes one or more of the owners might have been in another business or in another business that's generating some losses. And so they're willing to take on a little more of the profit in certain instances so that they can eat that up, or they want losses. So if this is generating losses, they're in another very lucrative business and they say, give me more of the losses, I'm willing to take them because it's going to help me shield the rest of what I'm making in this other business from tax. So there's a number of different reasons it can happen. That's one of the things that's dealt with here. Tax elections. An LLC can technically elect to be taxed like an S Corp, not to confuse this more, but Whether and when an LLC would be permitted to do that is oftentimes dealt with in this, as well as some other tax elections. If you're an S corp and you have a tax election, you've made the tax election obviously to be an S corp. There's usually detailed rules about everyone will continue to do what needs to be done to make sure that that S election stays in place. And one of those things is not transfer it to a person or entity that would cause that S election status to go away. And so those are some of the things that are also dealt with in the context of these governance agreements. The biggest thing, in my opinion, the biggest thing that's dealt with in the governance agreements, all those other things were very important. But one of the main things that you really want to deal with in a governance agreement is putting together buy-sell provisions. They say, why is that so important? Well, the reason that's so important is if you all decide to go into business with other individuals, you no doubt made that decision based on key attributes about those individuals. You've known them a long time and you trust them. They bring a certain value, whether that value be the money they bring to the table or their connections or the skills that they bring to the table. You respect them in whatever the business is going to be. But you've made a decision to be in business with those people. What buy-sell provisions do are basically make sure that you stay in business with those individuals. And if those individuals, the interests of those individuals would go to anyone else, you have a right to buy that out and not be in business with someone else first. You get a right of first refusal, which we'll talk about. So what these buy-sell provisions generally say is there's restrictions on transfer, and it says, except as expressly provided in this agreement, the owners of this business cannot transfer their interest, and that transfer is generally broadly defined to be selling it, gifting it, assigning it, and also things like pledging or whatever else. You can't do any of those things with your interest except as expressly provided in the agreement. So you're making up rules for how you will transfer your interest in this closely held business. We talked earlier about making sure that it's closely held, kept only with the people you've chose to be in business with, or subject to the rest of these provisions who you ultimately allow it to happen. And so, and like I said, for an S corp, you're particularly concerned about this because if it goes to the wrong person, say an entity, you'd blow your S election and now you're subject to double taxation. And that's exactly what you were trying to avoid. Now, the second thing here that we talk about is sometimes people they agree upon a set of transfers that, notwithstanding that overall rule, are permitted. And one of the ones that comes up a lot is, we talked about estate planning earlier. Someone says, well, I want to be able to give it to my children. And especially if they're in the business, sometimes that's fine. But sometimes people who are in your position say, listen, I love your kids. I know them well. We're in business together, but I don't want to be in business with your kids. So you can transfer it to a trust set up for the benefit of your kids, as long as you remain the one that's in charge of that. You're the trustee of that trust, because I don't want to actually be dealing with your children. I want to still be dealing with you. So that's some of the negotiating that happens on permitted transfers and whether or not you're able to do it. Another big one is whether or not someone could transfer it to their wife, whether during their lifetime or upon their death. Sometimes people just do not want to be in business with someone's spouse, whether it be a husband or wife. You say, listen, I either like them or I don't like them, but I don't want to be forced to be in business with them. And so that's what this is designed to do, try to make sure you're not forced to be in business with them. Another one is mandatory purchases. So sometimes people say, listen, I'm happy to be in this business, but if I die, I want everyone else's commitment that you guys will buy me out of this business, because I know my spouse wants nothing to do with this, and I don't want them stuck in this business that I wanted to be in, they didn't want to be in as an owner. So upon my death, I want to make sure everyone agrees to buy me out. We'll set forth in the agreement what the price is and all those other things, but it's mandatory, you have to do it. Sometimes it's for things other than death, but death is the most specific. But if there is anything like that, and when you're matching this to your desires on the way in, you want to find out, okay, we want all these rules in place so we know who am I permitted to transfer, who am I required to buy out, and matching that all up. With respect to a right of first refusal, which I talked about earlier, what a right of first refusal would be is if someone's in your business and they say, I no longer want to be in this business, I want to be bought out. That's what we call a withdrawal. Now, sometimes you're not permitted to transfer your interest unless you find a third party offer. Third party offers, you find someone else who wants to buy your interest, then come back to me. But otherwise, you can't just say I want out and you either buy me out or I can sell it to whoever I want. Sometimes you say you have to have someone who's willing to buy it. In either of those cases, ultimately, when there's an offer, something we call an offer on the table, whether it's a third party offer or if you allow them to make an offer to sell it otherwise, then the other owners of the business have the ability under a right of first refusal to either buy out that interest or to allow that interest to then pass to the third party. Now, the third party will ultimately need to be a party to your governance agreement as well. But the benefit of doing that is you at least get a first crack at keeping the entity closely held amongst the owners of who started this thing. And let's say you don't like that third party or don't know them, or upon someone's death, it would transfer to their spouse or the kids or whatever else. By having this in place, you're able to basically block that, pay the money, that we'll talk about in a minute, but you can keep the control of your own destiny. You're not subject to having to be in business with someone you don't want to. This gives you that control. Now, subject to having the money and being willing to do it and everything else, but that gives you the control. What a deemed offer is, and I alluded to a little bit earlier, what a deemed offer is it's not someone telling you they want to leave as what we call an offer, but it's actually if certain events occur that would lead them to no longer have control over their interest. And so those deemed offers are someone dies, their interest then will pass through their estate. And then if you don't exercise your right of first refusal, it'll go according to their will or intestacy to whoever their heirs and beneficiaries are. So what people normally do is say, in the event of any of these deemed offers, I have a right of first refusal to buy it the same way as if you would offer me it if you were still alive. If you're in a business where everyone said, listen, we're going to be in this business, and the reason we're bringing everybody on is we all add skills to this thing and we're expecting everybody to work full time in this business. When those are the understandings on the way in, then someone, if they become disabled, they're no longer able to work, or if their employment or their engagement with the entity ends, and sometimes that's addressed with an employment agreement or an independent contractor agreement, which says when that can happen. But if you're no longer working for the business, that becomes a deemed offer and the people are able to buy you out. That's frequently not used if your business is something that's like what we call passive investment, like a real estate business. Most real estate people, although there's some management that needs to happen, once you buy the building and get it lined up the right way, there's not a lot to be done day to day. So a lot of times in a passive investment like that, someone becoming disabled or no longer being employed or engaged, if they even were, oftentimes is not viewed as a deemed offer. If someone becomes bankrupt, same way that their interest would pass through their estate when they die, a bankruptcy estate is established as part of the bankruptcy proceedings, and then that bankruptcy trustee has control of that interest rather than the individual who filed for bankruptcy or had an involuntary bankruptcy proceeding filed against him by his creditors. Generally speaking, people don't want to be in business with a bankruptcy trustee. So if that deemed offer gives you the ability to buy the person out, then you're able to make sure that you don't have to do that. Similar, like divorce proceeding, it might go to the divorced spouse, and a lot of times that's a really uncomfortable position, especially if that divorced spouse would own part of it and the other divorced spouse would own another part of it, and then you've got borderline fist fights in your meetings about the owners. A lot of times you want to avoid that. Same thing if a creditor seizes the interest or if a trustee is appointed with respect to the interest. In all those instances, it's what we call bad circumstances, and you probably don't want to leave it in the hands of that, but rather buy it out. So you pay cash, for instance, to the bankruptcy trustee for the interest. They no longer own the interest. They're not involved in the operation of your business. You then get that interest back and you keep it closely held. Some other buy-sell rights that work their way into it. This one sounds pretty violent, but it's really not. It's called a shootout. What a shootout happens is if you have two equal owners. Sometimes what happens, despite the best of intentions, you have two 50-50 owners. They go into business together. They think it's going to work great. And they end up, in a lot of instances, just not seeing eye to eye. Or after a period of time, they no longer want to work with each other. What a shootout allows them to do is to make sure they're no longer in the business together. And so what happens is either one of them can say to the other one at any time, buy me out for whatever amount of money they say. And then the owner that didn't make that shootout offer has two options, and only two options. They either buy them out for that amount of money, or they sell their interest for that same amount of money to the person. So when you make a shootout offer, you don't know whether you're buying or selling because it's out of your control once you do it. So basically you're saying either buy me out for $100,000. If you won't agree to buy me out for $100,000, I'm buying you out for $100,000. The benefit of it is in either of those instances, once you make that offer, the one thing's clear, you're not going to be in business with that other person anymore. The other way that issue is sometimes dealt with is either party can unilaterally dissolve the thing, but this is something we recommend to people often so that if they're in 50-50 owners and there's the possibility for deadlock and everything else, you can force your way out of that deadlock. A put option is basically if an owner has the ability to require another owner to buy them out. You see that less frequently, but sometimes it's there. And so you say, you must buy me out for the put option price we come up with or the formula we decide to use for it. And it's not optional like some of the other ones we talked about, it's mandatory. A purchase option is the exact opposite. If someone has the option at some point to tell another owner, without your approval, I can buy you out for, again, X amount of dollars or whatever the amount of money provided for under the agreement. Purchase price issues. So because you don't want to be arguing what the price is for all these different interests we're talking about, the governance agreement normally sets forth, or it should set forth, the manner in which the purchase price for an ownership interest purchased under the governance agreement, how will that purchase price amount be determined, and how will it be paid? If you agree upon these issues in advance, you don't have to get into protracted litigation and all those other things. You can just, the agreement's clear on what all needs to happen. Valuation method. How do we value the interest? Lots of people disagree on it. Here's that way that happens most often. Appraised value, if and when one of these events would happen, you go out and hire a third-party business appraiser who is certified to do these types of business appraisers. They tell you what the business is worth, then you times that by the person's ownership percentage, and that's what they're paid. Sometimes there's discounts, minority discounts, lack of control discounts. They say, well, that your interest shouldn't be the full value, 20% of the value of the company, it should be less than that. You can decide on how many different appraisers you have. Sometimes you each get an appraiser and then you get a third appraiser to break that deadlock if they're not within a certain amount. Lots of different ways to do it. Sometimes you can specify how many numbers of years of financials are to be considered, like, informing the opinion as to how many years, as to what the company's worth. They'll look at no less than 3 years of financials, or sometimes less, or sometimes more. All that can be addressed. What the value is, they just agree on it. We say, hey, listen, we think the whole company's worth $1 million. Every year we'll look at it again and see if that changes. You normally have default rules in place for if the person value, if you basically end up not determining what that interest is. So, 10 years have gone by and you haven't redetermined the purchase price. Oftentimes then it says it'll go to an appraisal, or sometimes it's determined by a predetermined formula. Other purchase price issues, is it going to be paid in full at closing, or is some or all of the purchase price going to be paid at over time? When you're deciding on that factor, you want to make sure you don't bankrupt the company. So you want to come up with something that's fair for both parties, and sometimes giving that seller the ability to pay over time, at least in certain instances, or the buyer to pay over time over certain instances is something that's done a lot. If that is going to be done, then the question is, okay, how long is that payment period? What's the frequency of payment, monthly, quarterly, annually? Is there any security provided for it? So in other words, is there collateral to make sure that that's paid? And sometimes it's the interest being purchased. Will a note be provided to evidence the seller financing? If so, does it have what's called a confession of judgment clause? A confession of judgment clause allows you to go right to court and get a judgment without having to go through a whole trial. That's oftentimes used. Will interest be charged? And if so, how much? Is the person who's operating the business while you're being paid, is there any restrictions on what the company can do? Sometimes that's in there. Are they required to maintain what we call buy-sell insurance during the buyout? And we'll get into that in a minute. And if those insurance proceeds come in, are they required to apply them? So that's all these kinds of issues are what's addressed in these governance agreements. So there's no questions as to same. Other buy-sell issues, are you going to have a release of personal guarantees? So if, we talked about it earlier, if you've executed personal guarantees for the business when you're bought out, are the owners going to have to try to get you released from them because the bank might not otherwise release them? And if they're not able to, and depending on what type of efforts you're going to require of them, then they're typically required to indemnify you. Indemnify you means basically hold you harmless. And if you're sued for it and lose money, then they pay you. The other thing we talked about earlier was mandatory or permitted buy-sell insurance. Buy-sell insurance basically means if you're in business, two people together, you each buy insurance on the other person, life insurance on the other person. So if that person dies, then you're the beneficiary of insurance proceeds, and then you have money available to buy out that other person. Same thing could happen for a disabled owner. And rather than the owners owning it, sometimes the entity itself owns it, and then they have the obligation to buy you out, use those insurance proceeds up to the extent of the purchase price to buy you out. Sometimes owners, because they want to make sure that their interest is going to be bought out in the event of their death, they make sure that happens. Some other issues, and we're running out of time, we'll go through them quickly. Sometimes you have provisions in there that restrict what the owners may do with respect to the business and for a period of time after they are owning the business. Non-disclosure covenants, what you can disclose about what you learned about the business. Non-competition, after you leave, are you able to compete against the business? Non-solicitation, are you able to try to take the business as customers? Non-rating, are you able to take the customer or the business's employees? Non-disparagement, can you badmouth the business? Non-circumvention, can you try to prevent the company from continuing to conduct business with certain people? You go to a customer and you say, stop working with them, these guys are terrible, or vendor or something like that. These are sometimes included in the governance agreements. There's rules for how long they can last, and you have to make sure that they're going to be enforceable. Sometimes the non-disparagement is made mutual. Additional protections, sometimes most of these have indemnification in place so that if you're sued based on your role with the company is going to basically hold you harmless. There's certain types of conduct that can't be indemnified against. That's all addressed in here. You make clear that you have a limitation of liability. The limited liability we talked about earlier, that's put right in the agreement. And then sometimes you require the entity to maintain what's called D&O insurance, which is directors and officers insurance, so that there's insurance there to hold you harmless if you're sued in your role as a manager or an officer. The last thing, and this is sort of the end of the entity, is governance agreements usually have rules in place for if we want to shut down this business, what approvals are required to have us do that, who's going to be responsible for doing it, and then how are we going to chop up the rest of the assets if there's anything left when we're done. So that is my presentation. I think we have about 5 minutes left, so I think I timed it pretty well, Dr. Pace, and I'm happy to answer any questions.
And if you have a question, please feel free to unmute or drop your question in the chat box and we can read it for you. All right, looks like we have one in the chat box. In a GP, no filing, If partner A agrees to a contract, is the contract valid if partner B does not want to abide by the contract?
Yeah, I mean, that's part of the problem with the general partnership, and it may be. So there's what's called agency law, and some of the question would be whether the other person who's a party to that agreement, whether they should have reasonably relied on that person's authority to do it. But generally speaking, each general partner is able to bind the general partnership. So they probably would be able to do it unless that third party knew, for instance, that you guys had an agreement that said both of you needed to agree to everything and they had a reason for knowing that you weren't. But generally speaking, part of the problem with a general partnership is exactly that each person, absent rules otherwise, is able to bind them. And so, depending on what the third party knew or didn't know, that could be enforceable. Well, I enjoyed giving this presentation. Certainly, if questions come up later, because I know it was a lot of information, Dr. Pace has my information. Anybody could feel free to send me an email, and we'll try to be as helpful as we can. But these issues are important. We do them every day and in every week, certainly on things. And it's important to find somebody too who does this. I specialize. What I've done my whole career is business and finance law. And when you do this all the time, you have agreements in place to deal with all this stuff. So you're not reinventing the wheel. And so many times things come up again and again and again and again that as people ask you about issues, you've dealt with it already and you've seen it dealt with poorly or better in a bunch of different circumstances. And depending on what your business is, a lot of the things we talked about earlier would be better dressed one way or the other if depending on what business you're in. Like, for instance, we didn't really make the distinction between a business corporation or a professional corporation in the context of corporations. We're talking about them more in general and more how they're taxed. But sometimes, like if you're going into let's say you're a dentist and you're going into a dental practice, you do a professional corporation because you want to make sure that everyone who's going to be in that business is a licensed professional because that's required and you think that makes the most sense. So there's lots of additional issues, but because we wanted to keep this to an hour and wanted to respect everybody's time, we limited it.
Well, thank you, Paul, for being here with us today and taking the time to share your valuable expertise. We really appreciate it. Just a quick note before we end the webinar. I will be making available the recording of this training on the Wilkes University SBDC YouTube channel, and I will email that link to all the attendees afterward. And I'll also be sending out the link to a post-event survey so that we can determine which of our resources best suit your needs and what topics you'd like to see as training sessions in the future. And with that, I want to thank everyone for attending this training today. And if you have any questions, please don't hesitate to contact us at the SBDC. I hope that you all have a wonderful rest of your day, and I look forward to seeing you at future webinars. Thanks so much.
Thank you.
Bye, everyone.